Warren Buffett famously said, "Price is what you pay, value is what you get." RuPaul J. Bonsali added a bit more depth to that quote when she said, "Price is not the same as value. Price is what you pay, business worth is what you get. Value is the difference between the two. The larger the value spread, the greater the reward and lower the risk." Hey, what's up? I'm Russ, and here on Dapper Dividends, we're all about money, making money. And if that's you, like the sub. And check it out, the best investors look for businesses they like that are incorrectly priced and will buy even further below the intrinsic value that they place on those businesses. But no matter what price you pay for a bag of rotten apples, it's still a bag of rotten apples. Well, this company that I just bought that Warren Buffett also owns, indeed to me looks to be a mispriced company and anything but a bag of rotten apples. And after I tell you a little bit about the business, I'm going to show you the intrinsic value and the price that I wanted to buy below for this business, and I would love to know your thoughts on it as well. So in Q1 of 2022, Berkshire Hathaway bought more than 1 billion shares of Celanese Corporation, ticker CE, with an average buying price of $142.87, which is substantially below today's closing price of $93.82, which is a drop of 34% from the big buff dog's Berkshire Hathaway buying price way back in Q1 of 2022. We look at the handy dandy Buffett watch tracker here on CNBC. I'll have a link to this in the description below. We see that currently Berkshire does own about 9.156 billion shares of Celanese Corporation with an 8.5% stake in the company. It makes up 0.3% of Berkshire's portfolio, so it's pretty small. So Celanese is a specialty chemicals company inside of the materials sector, and they have products that are just all over the place. Obviously, most of us aren't going to know what these products are, but we do know what applications they go into. And again, they're everywhere from adhesives to appliances to your building materials to charging technology, the EV, cigarette filtration, packaging, medical devices, sweeteners. I believe it's the acesulfame potassium that they make. Blah, blah, blah. They have wood coatings, preservatives, paper special. Just they are all over the place and in so many different industries. And that's going to grow even more because they just acquired on November 1st the mobility and materials company that was formerly owned by DuPont, which, as they say, that will establish them as the preeminent global specialty materials company. So back in July, Moody's said that Celanese plans to issue up to $9.5 billion of debt, which, along with a 3-year term loan and balance sheet cash, that will be used to fund the $11 billion acquisition of DuPont's mobility and materials, as they call it, M&M. Don't go thinking Hershey's and getting all excited. Business later in 2022, and Moody's gives a negative outlook. But it is Baa3, which is at the lower end of investment grade, but it is still investment grade. So I think it's moderate risk, but something to pay attention here as investors to a business. We need to know things like this, that the vast majority of free cash flow will go towards debt reduction and enable Celanese to repay $3.5 to $4 billion of debt by the end of 2024. But I like this. I think this is a great buying opportunity because there's a lot of uncertainty and a lot of headwinds. And I think what Moody's is going to show us right here is a little bit of what the market is pricing in when they say there are indications that inflation, along with elevated oil and energy prices, that are beginning to weigh on the global economy. Duh, we all know that. But in addition, Moody's is concerned that lower natural gas storage levels in Europe and Germany especially could negatively impact Celanese's operations this winter, either through restrictions or natural gas availability for industrial uses and very high energy prices, or a combination of both. But they do recognize and they do point out that the assets of the M&M business, M&Ms, that Celanese is acquiring are extremely complementary to its existing engineered materials business and accelerate Celanese's goal of becoming a leading global supplier of high-performance polymers. So yeah, they spent a little bit of a pretty penny to acquire the M&M business from DuPont, but it should help to accelerate the revenue, the sales, expand Celanese's reach in the world and the things that they do, and thereby bringing in more cash, returning more cash to shareholders. Because as we see, they just declared a quarterly cash dividend of 70 cents a share, but it is reflective of a 3% approved increase in the company's quarterly common stock cash dividend, so they raised that dividend 3%. And looking at their recently released consolidated statements of operations, unaudited, remember the annual reports are audited, and consolidated here is the company as a whole, not the individual business segments. We see that the 3 months ended June 30th, 2022, their interest expense was $48 million. That has jumped up to $154 million. So they're going to have to be paying a lot more interest. And I do like what management wants to do in paying it off rather quickly. So that's why I always say debt is a real thing and it always is going to have to be paid back. So look at how quickly this jumped up. We're looking at December 31st, 2021 to September 30th, 2022. So not even a full year. Celanese's long-term debt jumped from $3.17 billion to $11.36 billion. So that is something that we are going to have to keep an eye on if we are going to invest in this company. So is it a solid investment? So we're going to look at Simply Safe dividends, and then I'm going to show you alpha spread and the intrinsic value of a worst case scenario that they put on the price of Celanese. So Celanese, ticker CE, gets a dividend safety score of 77 from Simply Safe Dividends up in 2.98% current dividend yield, which we're going to see is pretty high given their 5-year average. Their 10-year CAGR is really high. Their compound annual growth rate, 29%, which is very fast. 15% 5-year CAGR, but their last increase, again, 2.9, it was 3%, which we heard about earlier, but that keeps their dividend streak growing. 12 years of growing dividends, 16 years of uninterrupted dividends. We see that is currently good for $2.80 per share annually, which again, 70 cents per quarter. Now check that out. Their current dividend yield is 50% above their 5-year average. Do it, highlight it, God. And you always have to keep in mind that this is backward looking numbers. These don't tell us anything about the future or what's going to happen. And that's where all the action is. So we always have to kind of realize that there's some risk. But let's see what they've been doing. Their forward PE is currently 7.7. You're paying $7.70 for every $1 of earnings that Celanese is going to be bringing in, and they are squarely at the lower end of that 52-week price range when they did dip as low as $87 a share, and well below the materials PE average of 16.7 for the sector. Just run through some of the financials really quickly here. The free cash flow payout ratio, which is what I love to use over the earnings payout ratio because the free cash is a lot harder to financially manipulate. 23%, really low. As you can see, Simply Safe looks for something below 60%. They have plenty of room to grow that dividend. Free cash flow per share, $12. I expect this is going to start coming down because they're going to be paying a lot of that free cash toward paying down the debt of the M&M acquisition. The sales growth has started to drop down, but still 22%, so not terrible there. They've been buying back shares all the way down to 109 million, where they were at 160 million in 2012. But I think we're going to see a pause in this while they're really going to try and start ramping up funneling as much as they can to getting that debt and deleveraging as quickly as possible. But their total sales, check that out, $9.6 billion, just up and to the right since 2021. But return on equity has been coming down. I think that's just reverting to the mean of the mid-20s to the mid-30s, and a decent return on invested capital at 10%. I mean, just an outstanding operating margin. And their free cash flow margin, 7%. So what that means, as I understand it, is that out of every dollar that comes into Celanese, they are currently bringing 7 cents to the bottom line. And that's after keeping the business running and doing everything they need to do to keep maintaining the business and growing the business, that 7% looks really nice to me, and I hope they can maintain that because we see it's come down since 10% 2016. And net debt may be ticking up a little bit here, but is last 38% in the 12 months prior, which is not very bad at all. And the interest coverage ratio, a little bit of a bugaboo here, only 7.45. And you know, if you watch the channel, that means there is $7.45 of operating income to cover every $1 of interest expense. I would like to see that a little bit higher. So I think Celanese looks like a solid company, but what about that price? What's a good target that would give us a margin of safety in a worst case scenario for the company going forward with their earnings? Well, alphaspread.com gives an intrinsic value in a base case, kind of as things are chugging along, not a best case, which would be $265, but the best case is $179. Now, what I think makes more sense is to look at the discounted cash flow value, because the relative value is comparing it to companies in the sector and itself and a few other metrics, which is $162.31. So it's 42% undervalued from that. But what about the worst case? Well, when we pick worst case, we see that the discounted cash flow value brings us to $111.43, making it about 16% less than its discounted cash flow value. And they get this number right here. This is their model setting. They use a 10.25% discount rate. So we're discounting the future cash flows 10.25%. The higher that rate is set, the lower the price will go. And again, a terminal growth rate of negative 4.13%. And it is for a 5-year period. So this is something that like Warren Buffett and a lot of investors will do. They'll put their own intrinsic value on a company, and using just that discounted cash flow value, remember, they're looking at it as being $111.43. If you want to do your margin of safety, back off 10% over that, just in case you're wrong, because we don't know what's going to happen in the future, gives us an undervaluation right now of about 16%. So that's a really, really high margin of safety. And this is something that kind of gives me the warm and fuzzy, is to see if the insiders have been buying or selling. Not a lot going on. Only one person, Kelly Thomas Francis, bought $255,000 worth. But we know that people will sell stock for dozens, if not hundreds of reasons, but buy for only one because you think that that stock price is going to go up. Hey, did you check out the video where I gave you my favorite quote? The quote that changed my life, really got this thing all started. It's in this little box next to my head, and you can go to work with me. So if you want to check out what I do and see kind of a day in the work life of Russ, then click that little box here next to my head. And if you do that, I will talk to you there.